There's a saying that there are decades when nothing happens, and then there are weeks when decades happen. Now, the first couple of months of 2025 definitely falls into the latter category. And joining me today to unpack some of the developments and discuss what investors should bear in mind is fund manager Shaun le Roux. So Shaun, you recently wrote an article in the latest Angles and Perspectives, where you argue that instead of investors being caught up in political rhetoric, they should focus on the implications of policy changes instead. Do you want to unpack that distinction for us a bit?
Yeah, Audrey, it has been a very eventful few weeks, but actually if we think about it, it's actually been an eventful year. So if we cast our minds back, we've had elections in South Africa and the formation of Government of National Unity, and we had elections in the US, and currently we're experiencing some of the outcomes of the US election. Now, if you as an investor were going to invest based on the emotion at any point in time or the headline that came out any week of the year, you would have been all over the place. And we've witnessed significant sell-off in the US recently and a massive recovery. And what we always say and what we always try and do is to invest unemotionally and invest not based on the rhetoric, but rather on the evidence. And if we're talking politics, it means what actual policy is coming out. And that's where we would be focusing right now.
So, you kick off with that article by looking at the Government of National Unity, the GNU in South Africa. And you argue that despite a lot of rhetoric, we have not seen evidence of policy changes coming out yet. Do you want to delve into that in a bit more detail?
Yeah, what we're saying there is that on April the 2nd, Liberation Day, ironically, we had the budget being passed in Parliament, and one of the parties, the key party in the Government of National Unity, the Democratic Alliance, they didn't vote in favor of the government. And that effectively gave rise to a lot of speculation that the Government of National Unity was going to fall apart. The rand sold off, domestic assets sold off, but from an evidence-based perspective, that didn't happen, and people were trading on the basis of sentiment. When we look into where things are today, yes, the coalition is fragile, but if we look into asset prices, they're incredibly depressed. So people are pricing in a very bad outcome, and the simple facts are that nothing has really changed. Yes, the coalition remains fragile, but it's still intact. And again, if we contrast that with the US, in the case of the US, we've seen some significant policy changes in the last few months that we think require some careful consideration.
So delving into the situation in the US, and you've referenced it, you do find that more concerning as you explore in the article, but maybe you can summarize for us again what the source of concern is there.
Yeah, I think investors globally need to take very careful note on what is happening. And it's not about the headlines. It's not about what is today's tariff rate, because frankly, next week, who knows? But what we do observe is a significant change in the world order. And the two areas I would call out are firstly international relations. Some of those long-standing treaties and alliances are in the process of being torn apart or significantly reshaped. And then the other area is trade, and tariffs are obviously the key and very blunt tool that will be used to reshape the global trade situation. And to be frank, the trade situation was unsustainable. We did have an unsustainable situation, but when you have very blunt tools being applied to reshape the world order, the long-term consequences are significant. And in particular, we would be contrasting the likely world of the future versus how people are positioned. And it's very clear to us that on a global basis, assets are positioned for the world of the future to look very similar to the world of the past, and we think the world is in the process of changing.
So, Shaun, you view investor complacency as one of the things investors should be keenly aware of. Why is that?
Well, remember that assets will always reflect sentiment. So if you look into a market, the price that people ascribe to equities, for example, would reflect how confident they are about the future. So if we look into the US market, the US market's still expensive. We think that implies that people are betting that the US exceptionalism narrative persists. We think it's very long in the tooth. We see clear signs why part of that narrative is likely to disappoint into the future. And when we compare that to the valuations that are baked into assets, and particularly US assets and particularly equities, we think investors are very, very likely to be disappointed over the next decade. And then if we contrast that with other markets, and South Africa would be a great example, we see the complete opposite of complacency. We see very dire outcomes being priced into assets. And domestic equities, we think, can be bought today at a very wide margin of safety. And what that means is that if the future is not great, we can still do okay. And if the future is slightly better than what is being priced in, we could do very well for our clients. And last year's election was a great example of that. Assets were incredibly cheap coming into the election. The outcome was better than what people expected. And the consequence was very handsome returns from domestic equities in the second half of last year.
So, Shaun, you mention in the article that the winners of the future may look conceivably very different to those of the past. Do you want to delve into that in more detail for us?
Yes, for sure. It's something our team has been writing about for several years now. And effectively, for 15 years, the only place to be has really been in US equities. And as we've discussed several times over the last few years, we see the ingredients for the winners of the future to come from different parts of the world. And if we look into what we think a portfolio requires to not only protect capital, but grow capital in the future, we think it'll look very different to the average portfolio that is very overweight US assets. We think you need to be looking into other markets, out of favor markets. Emerging markets would be a good example, and we think South African assets fall squarely into that camp. But at the same time, we think portfolios will benefit significantly from having high exposure to real assets, because it's our view that inflation is much more likely to be a concern in the future, in other words, in the next decade, than it's been in the last decade.
Shaun, thank you so much for sharing your insights with us. As always, it's been great to have you.
Thank you, Audrey. I enjoyed that.